Hey everyone, welcome back to Corporate Decoder. Today we're diving into Parsons Corporation's latest quarterly report, and let me tell you, it has got more twists and turns than a military intelligence operation. So Parsons Corporation, a big name in engineering and technical services, has just filed their Q3 2025 report. What is in store for them? Well, let's just say the numbers tell a pretty interesting story about their recent wins and maybe a few head scratches. Before we get into the nitty-gritty, if you love breaking down these financial reports and understanding what is really going on behind the corporate jargon, make sure you hit that subscribe button. And hey, we've got a fantastic community discussing these things over on our Discord, linked in the description below, so come join the conversation. First up, let's check out the main numbers. This is where we see the real picture of how the company is doing financially. Looking at their balance sheet as of the 30th of September 2025, Parsons has total assets of over $5.7 billion. That is a solid number, showing they own quite a bit. Now, if we look at what is owed, their total liabilities are around $3 billion. This means they have more assets than liabilities, which is generally a good sign. Their accounts receivable, which is the money owed to them by customers, stands at a little over $1.2 billion. And looking at their contract assets, which is money earned but not yet billed, that is another juicy $822 million. This shows they have a lot of work in progress that will turn into cash. Now, here is something interesting. Their goodwill is over $2.1 billion. Goodwill is what a company pays over the fair value of an acquired company's assets. It can show a company is actively acquiring others. On the flip side, their accounts payable, what they owe to their suppliers, is around $271 million. This is a pretty normal number compared to their assets and revenue. Now let's peek at the shareholders' equity. Their additional paid-in capital is a massive $2.6 billion. This is basically the money investors have put into the company above the par value of the stock. This shows strong investor confidence. They have an accumulated other comprehensive loss of about $24 million. This reflects unrealized gains or losses on certain investments and currency translations, not directly related to day-to-day operations, but still important to the overall picture. Moving on to the income statement, we see how much money they are making and spending. For the 3 months ending the 30th of September 2025, their revenue was about $1.6 billion. Now compare that to the same period last year where it was over $1.8 billion. That is a drop of around 10%. For the 9 months of the year, revenue was down to around $4.7 billion compared to over $5 billion last year. That is a decrease of about 5%. Their direct costs of contracts followed a similar trend, decreasing by about 13% for the quarter and over 7% for the 9 months. This makes sense as lower revenue usually means lower direct costs. Here is where things get a bit more interesting. Their selling, general and administrative expenses, or SG&A, actually went up by about 5.7% for the quarter and by a significant 9.5% for the 9 months. As a percentage of revenue, SG&A climbed from 13.6% to 16% for the quarter, and from 13.8% to 15.9% for the 9 months. This suggests they are investing more in the business, perhaps in growth initiatives or acquisitions. Now, the bottom line, net income attributable to Parsons Corporation. For the quarter, it was about $64 million, a bit lower than the $71.9 million from last year. For the 9 months, it was $185.5 million, up slightly from $180.8 million last year. So while revenue is down, they managed to improve their net income over the longer 9-month period, likely due to better cost management in other areas. Interestingly, for the 9 months ending the 30th of September 2024, there is a line item for a convertible debt repurchase loss of over $18 million. This is a one-time event that impacted the results, and if we look at the notes, they explain how accounting changes affected how this loss was recorded, shifting it from an extinguishment loss to an induced conversion. This is a bit technical, but essentially they changed how they accounted for buying back their own debt, and it made the reported loss smaller in the current period compared to an earlier accounting treatment. Parsons has been busy acquiring other companies. They bought Chesapeake Technology International Corporation, or CTI, for around $91.5 million in June 2025. CTI, they say, boosts their capabilities in all domain technology solutions for the Department of Defense. Then, in January 2025, they acquired TIS Group. Incorporated for about $36.6 million, TRS specializes in environmental solutions and remediation technology, which expands Parsons' environmental services. In November 2024, they purchased BCC Engineering, LLC, for a hefty $233.5 million. BCC is a big player in transportation and civil engineering. especially in the southeastern United States, and going back to August 2024, they acquired Black Signal Technologies, LLC, for over $203 million. Black Signal is all about digital signal processing, electronic warfare, and cybersecurity, which they believe strengthens Parsons' position in cyber warfare and counterspace radio frequency. These acquisitions explain a lot of the increase in SG&A expenses as they integrate these new businesses. Let's look at how their two main business segments, Federal Solutions and Critical Infrastructure, are performing. In Federal Solutions, adjusted EBITDA, a measure of operating performance, dropped by nearly 40% for the quarter and over 31% for the 9 months. Revenue also saw a significant decrease. They mention a confidential contract with reduced volume due to a Department of State reorganization as a key reason. This segment is clearly facing headwinds. On the other hand, Critical Infrastructure is the star of the show. Revenue jumped by over 18% for the quarter and 15.5% for the 9 months, driven by organic growth and those recent acquisitions. And their adjusted EBITDA for this segment more than doubled for the quarter and grew by over 89% for the 9 months. This segment is clearly powering the company's growth. Their book-to-bill ratio, which compares new awards to revenue, is hovering right around 1.0 overall for the year to date. This means they are winning about as much new business as they are booking revenue, which is decent but not spectacular growth. Federal Solutions is slightly below 1.0, while Critical Infrastructure is above 1.0, mirroring the overall performance trends. Now, let's talk about their cash. They say they have adequate liquidity for at least the next 12 months, thanks to cash from operations, existing cash, and their revolving credit facility. Their working capital, the difference between current assets and current liabilities, increased significantly, which is a good sign of financial health. Looking at cash flows, operating activities provided over $310 million for the 9 months, which is down from last year mainly due to changes in working capital. Investing activities used nearly $188 million, largely for acquisitions. Financing activities actually used over $156 million, a big shift from last year when they provided cash. They paid off a lot of debt and repurchased stock. On the market risk front, they are exposed to interest rate fluctuations with their revolving credit facility and term loan. The interest rates are variable, meaning they could go up or down depending on market conditions. They also have some foreign currency exchange risk, but they've managed it with contract clauses, so it doesn't seem to be a major concern right now. Parsons is involved in a few legal battles. There is a False Claims Act case that went in their favor with a summary judgment. Though the other side is appealing, there is also a breach of contract case from a few years back where Parsons won a significant judgment, but that is also under appeal. They believe these legal matters, while serious, will not materially harm their financial position. So, what is the verdict on Parsons Corporation? They are a company undergoing a major transformation. They're clearly leaning heavily into acquisitions, especially in the critical infrastructure space, which is paying off with strong revenue and profit growth in that segment. However, their Federal Solutions segment seems to be facing some challenges, likely due to government spending shifts and contract changes. The increased SG and spending, while a concern for short-term profits, signals a strategic investment in growth for the future, particularly with those recent acquisitions. Their debt management and liquidity appear sound for now, but the reliance on new contract wins and successful integration of acquired businesses are key to their continued success. It is a mixed bag, with a clear bright spot in critical infrastructure that is helping to offset some headwinds in Federal Solutions. They are definitely a company to watch as they navigate these strategic shifts. That is our deep dive into Parsons' latest filing. What are your thoughts on their strategy and these numbers? Let me know in the comments below. If you found this breakdown helpful, please give it a thumbs up. It really helps the channel, and subscribe for more corporate secrets revealed. Don't forget to join our Discord community for even more insights and discussions. Thanks for watching, and I'll see you in the next video.